Hello and welcome to this brand new episode of Smart Money. Today we have with us Prableen Bajpai, the founder of FinFix Research. She's a CFA, a certified financial planner, and she's been in the industry for over 15 years. And today the topic of discussion is something that's on everyone's mind, financial planning for millennials in the age group of 26 to 40. Prableen, thanks a lot for joining us on the show. It's very interesting, right? I mean, in the last 1 week, there was this article that went viral about the Mercedes head of marketing saying that people now prefer investing their money more in SIPs and in the market than in buying a luxury car. So that just goes to show that the awareness with respect to equity markets and the equity cult is definitely growing. But you tell us, how does one go about it in their early 30s and 40s? Because now people are starting to ask these questions. How can I sort of grow my corpus? How can I build wealth? Where do we begin?
Good afternoon, Sonia. Great to be here. Absolutely. I think SIPs are in news, and I think today we've had the latest figures, and the figures remain robust. So that is great news. Coming to investing in 30s, I think 30s is a great time to begin with serious financial planning. It is also a time which is going to see a lot of life events. So typically, when mamas and aunties start saying ki beta 30 ke ho gaye ho, shadi karo. So it can be regarding your marriage. It can be if you are already married. It can begin with planning kids. Usually home is something which is on the radar. And by the time individuals are in their 30s, Sonia, parents are also looking at retirement, and taking care of them can be an additional responsibility. So I think this is a phase where a lot of lovely events are there in one's life. But at the same time, what remains constant is that there will be a substantial increase in the expenses of such individuals. Okay. And the good thing is that these people have already worked for some time, 5 to 6 years, and they're more steady in the careers. I think pays are better. So it's a great time to sort of balance both things so that, your present is taken care of, and you can plan your future in the best possible way.
Okay, I'm glad you brought out this point about the SIPs, right? And I just wanted to put it on our big wall here, the number of SIPs that have gone up over the last many months. And it's helpful to understand. I mean, these are the number of new SIPs. In the month of October, it's almost 20 lakh new SIPs that we've seen compared to about 17 lakh new SIPs in the month of July. So the trajectory has definitely gone up. But even in terms of the quantum, right, the contribution, almost 13,500 crores has come in through the SIP route in the month of November compared to about 12,000 crores in the month of July. So it's really, this is of course just a 5-month chart, but if you map it in the last 2 years or so, it's really grown the amount of contribution through the SIP route. So tell us, Prableen, if I had to start, how does one really plan their finances in the early 30s? If I'm a 30-year-old, I've started, investing in the stock markets, should I just do it via the SIP route? Just start from the very beginning.
I think, Sonia, 3 things are very important for an individual to know. The first is what you earn, what you own, and what you owe. So what are you going to get on a monthly basis? What are you getting? What is it that you actually own, your assets, and what do you owe, the liabilities on you? So I think the beginning has to be probably a boring drill, but opening up Excel and writing down what is it that you're getting on a monthly basis. So you have to have all the cash flows, very nicely. Usually what's coming in is nicely known, but what's going out on a monthly basis is not well known. So you have to start writing down what are your monthly expenses. That's the very basics. Then write down your liabilities. What sort of loans are there on you? Because by the time people are in their 30s, there may be a car loan, they can be credit card overdues as well, maybe a personal loan or an education loan. So making note of all these liabilities is equally important. And then comes, the factor that how much loan can actually one have. So I think when we are doing this math, Sonia, people must understand that, the overall basket of liabilities in terms of what is going out on a monthly basis should be capped at 40% of their salary. So if I'm earning, like, let's say 100 rupee, not more than 40 rupees should be going into repaying of all these liabilities. So that's very crucial. And then you start writing down what exactly do you own. Do you have mutual funds? Probably you were doing employee provident fund, the PPF, just the way you said SIPs, probably mutual funds are there. And it doesn't, it's not just about writing these. You have to write what is the amount of investment which is there, and then divide it by the total amount of what you actually own. So a lot of people, they worry about, or they are sometimes happy about that. Okay, I'm investing in SIPs, but Sonia, the allocation to that particular asset class, to that particular product, has to be worked out, and that is what will define, how you reach your goals. So the overall allocations have to be known. So income, expenses, liabilities, and what you have, assets.
Okay, in fact, we have a very helpful table that's just flashing on the screen. The investments that you need to make across the board, right? Whether it's EPF, through the PPF route, what your current investments should look like. In fact, it's very helpfully here. If you put a current corpus, right? I mean, we're looking at about 20 lakhs that you can break up between the EPF, PPF, fixed deposit, mutual fund route, how much you need to invest and what the expected returns are. You've taken a 12% average return, Prableen, for mutual funds, which is fair, I guess. And the total return that we're looking at is about 7.5%. Can you just help us, can you run us through this table? We have it on the screen for our viewers, but just tell us, as a 30-year-old, what should my breakup look like? And what is my eventual corpus that I can get, say, at a retirement age of about 55 to 60?
Right. So Sonia, I think, personal precedes finance for a reason. So personal finance is, person to person centric,
Sure.
actually. But this is just a general breakup that if an individual has about, 18.5 lakh rupees and EPF, PPF is there, and about 3.5 lakhs of mutual funds, we are looking at what is the allocation to that particular product in the overall basket. So like EPF is about 24%, mutual funds were around 19%. But again, for each of these, instruments, we've sort of taken the tentative returns that one would be getting, because, mutual funds we're taking at about 12%. If it's an endowment plan, it would be about 5%. Your FDs would be around 6%. And that gives us the return weightage. Because you get to know that what is your overall portfolio return. No investment can be done in isolation. Ultimately, how you reach your goals is based on what your portfolio returns are. And through this breakup, one can know that what is the contribution of which particular instrument or asset class in the portfolio. And this particular breakup that we have, this is a very, very conservative one, because here we are seeing that the overall percentage allocation, the portfolio returns are only working out to be 7.55, and there is a higher allocation towards fixed income products.
So how did you, what is this 20 lakh figure? I mean, is it the contribution that you need to make over a number of years? How much is the monthly contribution that you're looking at?
No, so I think how we begin with, Sonia, is dependent on, first knowing where do we want to reach. So this is a general breakup, and I think the planning has to start by knowing that what is the requirement for a particular goal in the present date. So let's say as a 32, 33-year-old today, my monthly expenses are about 75,000 rupees. And I'm looking to plan for my retirement. So my retirement, by the time, let's say I want to retire at 55, the same monthly investment, expenses would be about 2.7 lakhs. So first we need to know what is the current expenses that you're doing. If it's a retirement goal, if it's some other goal, then the present value of that particular goal. So then we factor the inflation aspect into it. And once we have a final figure, then we look at which instrument can get us there. So it's like, knowing a destination. And if I have to go to the market, let's say, which is 5 kilometers away, I have to decide whether I want to take my car, I want to jog, I want to run. So I think that would depend on how many years you have, what is your goal, what is the corpus that you're looking to create.
Okay, I want to take this discussion on inflation forward because, that impacts everything, right? The way inflation is going as well. Let's do one thing. Let's take a short break, but don't go anywhere. We'll be discussing all our goals, our retirement focus, children's education. If you're in the age group of 30 to 40, you'd want to stay tuned in for this. Well, today on Smart Money, we're talking about how to plan your finances if you are a millennial. That's in the age group of 26 to 41. And Prableen Bajpai of FinFix Research has been speaking to us. Prableen, before the break, you were telling us that planning your goals is fine, but you need to keep in mind inflation, right? So your money is not going to be worth the same 20 years from now, given the kind of inflation situation that India is in. So tell us exactly, give us the numbers. How do I manage my expenses today, given the inflation situation?
Right. So inflation hits on multiple counts, Sonia. The first one being, let's say, the cost of living. So at 33, if your cost of living is 75 and you want to retire at 55, your cost of living, your monthly expenses would be 2.7 lakhs. And by the time you're 83, this would be almost close to 12 lakhs a month.
Wow.
So typically, it is doubling of your expenses every 12 years, if we go by a general rule of thumb. That means that is so crucial to factor in inflation while planning for your future, goals. Okay. Second is the impact on real return. Because this is where a lot of us just look at returns superficially without looking at the real returns. So a fixed income product today giving me 6%, and inflation being at 6% means that my real returns, Sonia, are zero. And if I add taxation to it, I'm actually, in negative. So there is depletion of purchasing power. So in nominal terms, there is no change. But in terms of my spending power, there is going to be depletion.
Okay, just one question there. Just one question. First of all, I don't know any 30-year-old who's thinking about what they're going to be doing at 80, at the age of 80. But I take your point. I mean, folks, if you are in your 30s, if you feel like, oh, my expenses are 70,000 per month now, when you turn 70, it's going to be much, much more. So get planning with your finances right now. My question to you is this, that, you want to, of course, keep inflation in mind. But what about some of your, you have large goals, right? I mean, if you want to buy a house, say in the age of this 30 to 40 period, a lot of people want to purchase their own home. If you invest all of your money in equities, then that goal may remain unfulfilled. So how do you sort of plan that?
Right. So, Sonia, let's go, at a broader overview. So going by a thumb rule, put not more than 40% of your money as EMI. So if you're looking to buy a house, it's good. Let's say 3 years down the line, you want to make a down payment. You can start saving something on a monthly basis, maybe a SIP into a debt fund. And that can help you with your down payment and keep your EMI within that limit. And of course, reduce your other, unproductive sort of EMIs, let's say your personal loans or your car loan, which do not even give a tax benefit. Then comes your investments. So investments, one, we know that today what is the requirement, and then we factor it, we add inflation to it, we get a future value, Sonia. And that is where, we start mapping that, okay, my EPF and my, let's say, 20,000 per month SIP is for my retirement, for a specific goal. You may have some medium-term goals. Let's say your child will be going to college after, let's say, 12 years or 10 years. That can be something, again, you have to look at what is the expense today, and then you start saving for it by factoring in inflation. So there will be a use of different instruments. It'll be PPF, EPF, as well as mutual funds together. It cannot be in equities totally, because we also have to maintain our asset allocation. There has to be a kitty for your emergency also. There has to be something in fixed income. And that is how, you create a robust portfolio, because finally, how you reach your goals is actually more dependent on how well diversified you are across different asset classes.
Okay, all right, got that. How does inflation impact planning for your retirement? I mean, what kind of steps do you need to take there?
Like I said, till your retirement, you have to see that what will be your monthly expenses. And then you look at the corpus. And here, Sonia, two very important factors when you're looking at your retirement is that, we usually think that, okay, even during my retirement years, maybe, I'll be getting a 8% sort of a return. It's a very usual assumption that I see. No, you're not going to get that. Even today, if we say that we put everything in, one of the best government schemes, which is going to give us 7.5%, it's very important to look at taxation during your retirement, because with the kind of corpus, monthly corpus that you would require, a lot of people will actually land up in a very high tax slab, 20 years from now. So keeping return expectations during your retirement years is very crucial. And then what is the age that you're looking at, for your retirement? Let's say if you retire at 55, are you going to cater till about 85 years of age or 90 years of age? So within retirement, of course, we factor in inflation, but also what are the expected returns from your retirement corpus that you're looking at and the longevity of life? Those to become very crucial. And of course, this is one of the goals which is best, I think, catered to through your EPF and SIPs and mutual funds.
Okay, well, most millennials I know want to retire at 40, forget about 50 and 60, right? And Gen Z, let's not even get there. They're not even talking about working. But I have a very helpful table here, so I just want to get that up on board about the retirement corpus that you need. So just explain this to us, right? If your current age is somewhere around 30 to 35 and you're looking at a retirement age of 55, your inflation rate taking 6%, your monthly expenses will be about 3 lakhs at the time of retirement. So you're saying a targeted corpus is somewhere around 7 to 13 crores is what you need. Just explain this to us. So how much do you need to spend or rather invest per month in order to attain that corpus?
Right. So the requirement here is dependent on why it varies, Sonia, because the monthly expenses are similar, about 3 lakhs at that time. But the target corpus is different because in one scenario, we've taken about 5% returns from the retirement corpus. Because by retirement, a lot of people are not wanting to invest in equities, though they should, but they're really looking at capital preservation. So we are taking a very conservative figure here. If we see that, they can get about 8% returns, the requirement of the corpus, which needs to be built, actually goes down to about 7.5 crores. And then finally, if we are looking at that, instead of 85 years, we are looking to cater to 90 years of age with a 5% return only during retirement, then the requirement further goes up to about 13.5 crores. And here, Sonia, the kind of the requirement would depend on which option is picked by them. So it can vary from, let's say, 30,000 a month to 40,000 a month, and further, depending on which option is picked by them to cater to this corpus, to build this corpus.
Okay, I know this topic that we're going to discuss next is something that you can discuss for over an hour or more. But just to briefly summarize for paucity of time, where do you include your health cover or your life cover into all of this? At what point do you buy term insurance? I do know that if you have dependents in your family, you need term cover for sure. But just an overview, for a 30-year-old, what's the best thing to do?
So I think if you're unmarried, but you have parents who are dependent on you, then you definitely require a term cover. Your requirement for a term cover, Sonia, increases if you're married and if you have kids. And you must revisit your term cover, let's say every 5 years, because probably the first time you got it, you had one kid, and maybe 5 years later, you have another kid. So that's very crucial. And the term cover must be increased if you have a huge EMI on you. Let's say you have one CR worth of home loan on you. You must increase your term cover in that case. Health cover, in addition to, I think, whatever is provided by your employer is a good thing, because you may want to take a career break, or there may be some other, situation where the cover may not be sufficient. So while you're healthy and young, I think cater to a health cover as well, which covers your parents. And I think thirdly, something which is very important is your contingency fund, which has to be, as a general scenario, has to be about 12 times of your EMIs, monthly expenses, your premiums, your investments, everything together. And of course, if you are in a, let's say you're running your own business, you're an entrepreneur, the requirement would go up. If you're a double earning income couple, the requirement can be slightly lesser. So this would depend on case-to-case basis, but I think these are, some of the non-negotiables while you start planning your future.
Okay, this was a very, broad brush overview, but very, very helpful one, Prableen. Thanks a lot for joining in and explaining to our viewers how they should go forward with achieving their life goals and what's the kind of financial planning that you need to do in your early 30s and 30s to 40s. Thanks a lot, Prableen, for joining in.
Thank you.
Well, with that, it is curtains down on Smart Money. But before that, we're going to tell you our financial tip of the week. Every week, we come out with some financial tools that can help you in your journey. And today, we talk about 5 important things to remember before you invest in index funds, in passive funds. First, you need to find out the expense ratio. Now, expense ratio is the fees that is charged by the investment company to manage the funds of investors. A reasonable expense ratio for an actively managed portfolio is about half to 7.75%. And for passive funds or index funds, the typical ratio is about 0.2%, but it can be as low as 0.02% or less in some cases, and hence the attractiveness towards investing in index funds. The second thing, find out the tracking error. Now, tracking error in simple terms is how much the fund's performance has deviated from those of the index. Ideally, the return of such funds should match those of the underlying index, but due to expenses and cash equivalent, it may be lower. Obviously, the lower the tracking error, the better it is for you. Third, find out the AUM of the fund. Larger the AUM, more stable the scheme is and better to invest in. Now, the AUM of funds are easily available in all fund fact sheets on the AMFI website, on Money Control, Value Research, etc., on the company's website as well. Fourth is taxation. Taxation of index funds, being equity funds, index funds are subject to capital gains tax. On redeeming the units of an index fund, you can earn capital gains which are taxable. It's the capital gains earned by you for a holding period of up to 1 year is short-term capital gains, which is 15%, and capital gains of over 1 year is 10%. And the last and final, most index funds have an ETF option. And for those wanting to buy in demat form or are keen on intraday trading and prices, you can look at investing via the ETF mode. Now, index funds have a higher expense ratio as compared to ETFs, but ETFs also have a transaction cost which is attached both at the time of buying and selling. All the best with your investments. With that, it's a wrap on this edition of Smart Money. Thanks for watching.